Minutes if you like. All right, great. So thanks everyone for joining us for this webinar this evening. We are going to talk about a very exciting subject, which is cost segregation, which may not sound like an exciting thing, but trust me, when you are hearing what Yonah Weiss has to say, you will be in love with this term. So before we get started, just wanted to do a little bit of a disclaimer. The following content is for informational purposes only. It's of general nature. The information shared, conveyed, and elucidated in this presentation is not intended to constitute any legal, tax, accounting, or investment advice. Any ideas or strategies discussed herein should not be undertaken by any individual without prior consultation with a financial professional or independent research. So now that that's out of the way, just a quick overview about Christine and myself. So my name is Margaret Kozlark. I have personally invested since 2016 as an LP in over 1,900 doors, mainly in the Sunbelt area. I've also been a co-GP on several projects. And I am also, I hold my residential real estate license in New York and Connecticut. And my partner, Christine, is currently the owner of 6 rental properties in Philadelphia and Westchester. She has been a JV and LP on multiple syndications, as well as a co-GP with me. And together, we have 32 million in assets under management, 2,200 doors, and we have been through 6 properties going full cycle. So before we introduce our illustrious host, Christine actually has a story that she would like to share about her personal experience with the topic of cost segregation.
Yes, absolutely. Thank you, Margaret. So I love cost segregation exercises. I love bonus depreciation, and I'll tell you why. So it's been very impactful to both me and my husband, because a couple years ago, I was working the 8 to 5 W-2 job, just really worn down and really thinking of other options, and went into the real estate world. And one of the main reasons and motivators was because of depreciation. Our family, we were paying almost 6 figures in taxes every year for almost a decade. My husband is a business owner, and he runs an S Corp. So we were just getting taxed very heavily. And when we learned about real estate, investing in real estate, and the amazing wonders of bonus depreciation, and I want to caveat, please do speak with your CPA and get a really, really great tax strategist and advisor, because they are going to be your best friend. We went from paying almost 6 figures in taxes every year and paying those quarterly payments, and I was just crying as I was sending it into the mail every quarter, to getting a refund for $30,000 in the first year that I started investing in real estate. And I was just like, why didn't I leave my job sooner? Because really all the money that we were paying was all the money that I was making myself as an employee. And because of things like cost segregation, bonus depreciation, that allowed us to offset a lot of our taxes. So it's truly an amazing thing. We're so excited to have Yonah here today to talk a little bit more about bonus depreciation, cost segregation. So
so if that has not gotten your attention, going from paying 6 figures in taxes to getting a $30,000 refund, I don't know what would. So with that, oops, went the wrong way. So sorry. Let's see. Let me introduce Yonah Weiss. So Yonah is a cost segregation expert. He has literally helped property owners achieve millions of dollars in tax savings. He's a real estate investor himself. He's also a people connector with more than 20,000 followers on LinkedIn. And he's also the host of the Weiss Advice podcast. And again, he's known as the Cost Segregation King. We will have his contact info at the end, but he's definitely something that you should seek out on LinkedIn to follow. So with that, Yonah, I'm going to stop sharing my screen here, and I will let you go ahead and share yours.
Okay, appreciate it. Thanks so much for having me on. It's great to be here and great to be joining you guys talking about a subject that, like we said, you could probably talk about in my sleep at this point, but it's an incredible topic. And as Christine mentioned earlier, it's one that can literally be a game changer in your entire investing and retirement and just family structure. When you talk about a great anecdote, not paying any tax. And I have hundreds of these stories from clients and investors. It blows my mind every time. So without further ado, I'd love to jump into the topic. Please, the Q&A box is open. The chat box is open. So if you do have questions along the way, feel free to write them down in there. We will get to every single question. And if for some reason we go over time, can't get to some at the end, as Margaret mentioned, you can definitely find me on LinkedIn and any other place where you might find me social media wise. So again, my name is Yonah Weiss, and we'll just jump right into this. I work for, just a brief introduction to my company. A lot of people think cost segregation, they see me, oh, I'm the cost segregation expert. But I work for a company, actually. The company is called Madison Specs. It's not my company, I don't own it, but it's the largest national cost segregation company. We've done well over 25,000 of these studies. In the past few years, we're averaging around 5,000 of these a year across the country in all 50 states, every asset class available. And we're going to get into, well, what is this? Because you may be asking yourself at this point, I don't even know what he's talking about. And he's talking about, what he's doing 5,000. Okay, so let's just jump right into this. So we're going to talk about tonight, understanding depreciation. What is it? Because really cost segregation is just a form of depreciation. What are the benefits? Who should be getting this done? Is this for everyone? Bonus depreciation. Okay, when's the best time to get it done? What's a real estate professional? And then how is it going to relate to passive investors versus active investors? We're going to do a case study so you can see the real numbers when we're dealing with cost segregation and how this is actually going to affect you and if you get it done on a property. I see we already have a great question from Janelle in the comments. So we're definitely going to answer that, whether this is, and that's going to be one of the slides later on about the real estate professional versus non-real estate professional. And we're going to talk about the benefits therein. So let's jump right into this. So depreciation. Now, a lot of people think depreciation is like a bad thing, right? And we really need to understand depreciation is a borrowed term. When we're talking about real estate and tax deductions, it's a borrowed term, meaning depreciation means that something's going down in value as time goes on. But from a tax terminology, it is the name of a tax deduction that you get based on that principle that things go down in value. Now, yes, certain components may actually be going down in value, and that's what this is going to be based on. But in truth, many things, especially your property, is actually going to be increasing, going up in value. And so it is a borrowed term, and it's very relative to your purchase. And I'll explain this a little bit later on, how that means, because this depreciation deduction begins when you buy a property. Okay, it doesn't start when the property was built unless you're the one that built it and put it into service first. So simply put, depreciation is a tax deduction. And when you buy a property, you're able to take that tax deduction of the entire value of that property over a 39-year period if it's a commercial property, or a 27.5-year period if it's a residential or multifamily property. And so those are kind of arbitrary terms, but we're going to see how the process of cost segregation is actually to break that down into different categories, because there are certain things that you can depreciate faster, like on a 5 or 7 or 15-year schedule. And let me just bring up my little fancy spotlight over here so you can see where my mouse is going over here. So what we're going to talk about tonight is this exact tax planning strategy called cost segregation. But again, it is subjective and it is really a borrowed term. And I want to kind of reiterate this many times, because not to think, oh, things are going down in value. No, this is actually a very positive thing, and it's a tax deduction just based on that concept. So let's just give a quick example. Let's say you buy a property for $1 million. It doesn't really matter what type of property. We will get into the differences shortly. Certain types of properties are actually more beneficial than others, but we always have to subtract a certain amount for the land. Land does not depreciate, which means it always stays the same. Okay, so we're gonna have to subtract that. I'm using 15% here, which is a pretty national average. There are certain places where it's less than 1%. There are other places like California where notoriously it's over 50% for some land values there and some beachfront properties. But typically speaking, the national average is around 15%. So the amount that you can depreciate, this is going to be called your depreciable basis, is going to be $850,000. So if you're doing a simple, what we call straight line depreciation deduction, anytime you buy a residential or commercial, any business or rental property, except for your personal residence, and want to just be clear on this, you cannot take this deduction for your personal residence. It's only for rental properties. If you do this, you're basically going to get a $21,000 deduction every single year for 39 years. If it's a residential, like we said, multifamily property, it's $30,900. So almost $31,000 a year. And this is called straight line. Every single accountant knows that you can do this. And almost every single accountant will take this on your behalf and will take this deduction for you. However, most and many accountants don't even know, even though cost segregation is directly from the tax code, they don't know or don't know how to apply cost segregation because it does require, as I'm going to explain, an engineering component to it. Okay. Now, simply put, what this means is this deduction is taken against your income. So if you made on this $1 million property, let's say you were making $60,000 a year of net operating income, okay, after all expenses, after the mortgage expense, after other types of expenses, you're making $60,000 of profit. That $30,000 deduction is going to be great because that's cutting your income in half. What that means is you're only going to be taxed on the remaining $30,000. So that's how depreciation works. How cost segregation works is actually probably going to double or triple that deduction during the earlier years of ownership, as we will explain shortly. Just want to keep an eye. Yeah, so Margaret and Christine are going to be monitoring the Q&A. So guys, if you do have questions, please do not hesitate to put something in there. Now, the fundamentals are the essence of a cost segregation requires an engineering component to it. So it's not something that accountants can do on their own. You need a company that specializes in this, because what we're doing is breaking down the actual property into different categories, into its really individual components. And so the name cost segregation is a really weird name. We're just segregating that cost. We're taking that original purchase price and we're breaking it down into different categories. But really, we're breaking it even further than categories into its individual components, which is why cost segregation used to be called component depreciation, which is much more of an appropriate name, because we're looking at all the components. And I'll show you in the next slide, or one of the next slides, what those components actually will be. Certain things that are going to be land improvements, certain things that are going to be personal property, things that are going to be depreciating at a faster rate. Once we identify what those components are and what their tax life is, we can then take those deductions at a faster rate. So we're going to be getting larger tax deductions in the early years. What we're not doing is creating deductions out of thin air. Okay, we're taking that $1 million, and instead of just taking equal amount every single year, we're going to be taking maybe $200,000 or so in the first 5 years, and it's therefore front loading certain deductions, as we'll show in a few slides, some practical examples of this. Now, this is the slide I was talking about. So essentially, when we're dealing with cost segregation, essentially there are 4 categories to depreciation. There's the land, which we mentioned does not depreciate. There's the building structural components that depreciate on a 27.5 or 39-year schedule. And so that's also something the engineers are going to identify. That's going to consist of like the roof, the walls, the floor, right? Foundation, windows, doors, infrastructure like plumbing and electrical. All of the value of that's always going to be the majority of the value of any type of property. However, there are 2 other main categories that it's really what cost segregation is based on, is the 5-year, what we're going to talk about here, 5-year personal or tangible property, and the 15-year land improvements. That means all of these things, when we find them, this is just taken from a sample multifamily property. So you're talking about building mounted signage, right? Cable, TV, rough-in, right? Closet shelving. These are different categories that are listed by the IRS themselves. Millwork, carpeting, equipment, furniture, anything that's movable, and even things that aren't movable, like decorative moldings or millwork or flooring or vinyl floors or window treatments. All of these things are treated as 5-year property, meaning the value of all of these components depreciate on a 5-year schedule, meaning you can take the value of that as tax deduction over the first 5 years. Okay, and we'll talk about later on about bonus depreciation even in the first year. But essentially, this is what we're doing. We're identifying, the engineers, what all these things are, and then adding that up and then taking the deductions at a faster rate. So too with the 15-year land improvements. Okay, we're talking about anything that's outside the property. Remember, land doesn't depreciate, but anything on top of the land does. And especially if you're talking about a large garden-style multifamily property, you're going to have concrete, you're going to have retaining walls, fencing, landscaping, right, playground equipment, swimming pool, all kinds of stuff like this, lighting, right, signage, all kinds of stuff. All of that has value, and the pavement and concrete and all the different types of pavements and concretes actually add up to different values. You're able to take those deductions over a faster rate. So this is really the power of cost segregation, is identifying what all those individual components are and then taking them at a faster deduction rate. These are just some examples of different types of properties. Any type of property, as I mentioned, whether it's a rental or business property, can do cost segregation. However, certain types of properties are better than others. On average, the amount that is allocated, okay, so we're talking about the average reallocation of faster depreciation, all right, to those 5 and 15-year schedules. Apartments, multifamily typically has around a 28% on average reallocation. So that means that once we've allocated a certain amount to land, the remaining amount, about 28% on average, will have that. Now, again, there are certain types of properties that will be less. If it's a city property where you don't have much land improvements, it's just, building, sidewalk, street, nothing else, then there's not going to be much land improvements there. It's going to be less, probably more closer to even 15 to 20%. But if you're dealing with larger multifamily properties where they are garden style, you'll get upper closer in the 28 to 30% depreciation. STRs, these are short-term rentals, also a large amount because there's a lot of appliances, a lot of amenities, furnishings, et cetera. We're getting on average about 30% there. Grocery store, et cetera, hotels. We're talking mainly about multifamily today. I just wanted to show you other examples. Self-storage, I don't know why it's not in here, but mobile home parks. This one's a little bit off the charts here. We're getting on average between 50 and 80% of depreciation because they are simply just land improvements. So that's another category. Warehouses and things like that have much less, again, because there's not much personal property in there. It's really just the walls, structure, maybe some shelving, some electrics, security, et cetera. But besides that, there's not much there. So any type of property can be eligible. And these are just some examples of what we're looking at. So just to recap, for those of you who joined a little bit late, on average, $1 million reclassified, we're going to get after-tax benefits. And I want to really kind of drive this home. What we're doing with cost segregation is not creating deductions out of thin air, number one, and we're not necessarily going to be getting a refund, okay? In Christine's case, we did, and there are many cases where you can get a tax refund, but what this will do is reduce your taxable income, okay? And because we're taking these larger tax deductions. Now, with larger tax deductions, it doesn't mean you're going to get that amount of refund. That just means that's going to reduce your taxable income. So if you have $1 million of income and you get $1 million of deductions, you've, based on whatever your tax rate is, without getting too complicated here, that's actually going to be your net savings. Okay, so just to, for example, reducing your tax liability, increasing your cash flow. And that's why I always say cost segregation is really a cash flow mechanism. It's a strategy to increase your cash flow, because the less income tax you have to pay, the more you have to reinvest. And that, with time value of money, that is more important today than it has been ever, especially, we know in the news, and we're hearing all about inflation. Inflation is out of control. It really is. And the value of money today, time value of money, has never been more important, because if you have $1 today and you can reinvest that money, that instead of paying taxes on it, you can actually use that and reinvest that to make more money. That is going to be much more than just keeping your money in the bank or paying it and not being able to do that. So that's what time value of money is. $1 today is worth more than $1 5 years from now, et cetera. Even though, again, we're not creating new deductions, we're just front loading a certain portion. So we'll get to what happens when you sell a property, or what happens 5, 10 years down the road. Does it catch up to you? Maybe. We're going to get to that, but it's important to note the power of having that money today and using that to reinvest is so much more powerful than whatever you would have to pay later on. And Janelle, self-storage facilities are definitely eligible for cost segregation. I'm not sure why I didn't list everything there. It was a incomplete list on that chart over there. But any type of property, really, and we've done golf courses and farmland and orchards, you name it, any type of property out there you can imagine can be done. RV parks, right? Campgrounds, those are a lot of fun ones people are doing nowadays. So let's move on. Who should be doing this? Okay, really, it can apply to anyone as long as you are an income taxpayer. Meaning, if you're a nonprofit or a government entity, or maybe you're investing from a retirement account. And this is a really important one, because this is something that's very common, especially nowadays. People are investing from direct, self-directed IRA, 401k. They call them QRPs, qualified retirement plans. If you do that, that's already a tax shelter, and many of them, you won't be able to benefit from the depreciation. So if you are, a syndicator and you're taking on investors from retirement plans, be aware of this. It may not actually benefit you or any of your investors. And so this is something to keep in mind, but it doesn't matter what type of entity is the property is held in, you can benefit from the cost segregation. Okay. And whether it's a partnership, it's an LLC, and oftentimes syndications, you have limited partners, general partners, it is going to be divided up according to the percentage of ownership of the LLC, of the ownership of the property, and that depreciation will flow through to each of those investors. So if you have, let's just keep it simple, $1 million property, and everyone puts in, $100,000, and it's all cash investment, each person will get 10% of the depreciation that comes from that property. If it is leveraged, and this is really important here, and I'll get to this a little bit later, but just important to note here, the cost segregation, the depreciation is based on the purchase price, not how much money you put in. So if you buy $1 million property with 20% down, and the bank pays the other 80%, well, guess what? You still get to take the $1 million of depreciation, even though the bank financed it. So in that case, if you have 10 investors, right, $200,000, and everyone puts in $20,000, but you're going to get 10%, each one's going to get 10% of the depreciation. If the depreciation equals $200,000 in the first year, and I know I'm just throwing out numbers here, so keep up with me, but 20% of your property is going to go to depreciation, then guess what? You can actually be getting each person 100% of their investment back as a tax deduction in that first year. And so this is why you'll see a lot of times syndicators talking about 100% bonus depreciation. You'll get 60% or 70% of your investment in the first year as a tax deduction. That's kind of what they mean. And I don't want to go too much into that, because I actually honestly think that a lot of syndicators out there are misrepresenting that number a little bit and don't really understand how that works. And but I want to just put that out there. That's where this number is coming from. Again, it's based on the percentage of ownership and based on the percentage of the cost segregation. So who should be doing this? Anyone can be doing this, but as Janelle was asking earlier, and as we'll see in the next slide, it's going to be more beneficial to some people more than others. And this is one of my favorite paraphrases of George Orwell's Animal Farm, is that, all animals are equal, but some are more equal than others, right? All taxpayers are equal, but some are more equal than others, meaning to say that this real estate professional status that I'm going to define right now from the IRS actually have a greater benefit than anyone else, okay? So let's first define what this real estate professional is, and then I will show you how this is going to apply to you and to the depreciation. So first of all, a real estate professional defined by the IRS, this is taken directly from IRS publication. So these are not my words. This is directly just formatted differently. A real estate professional is someone who, either you or your spouse, only one of you needs this status to get this, this benefit, that you have two requirements. Number one, that more than half of your time is spent materially participating in the real estate trader business, which is going to be these things in the second column here. So you need to be full-time. Now, even though the IRS says only more than half of your time, essentially every single court case that has come out when this has been challenged and someone had a full-time, had a W-2 job or had a job other than real estate, and were still trying to claim this, they were overturned. Meaning, even though they say more than half of your time, essentially it means you cannot have a W-2, a full-time W-2 job, and also claim this, even though you may actually be spending more time, right? If you're spending 40 hours a week in your job and another 45 hours a week on your real estate properties, the IRS cannot fathom that someone can work more than 40 hours a week. And so your case will be thrown out and overturned. So, but essentially what it means is you need to be full-time and you have to spend at least 750 hours a year in that year. And this is looked at on a year-by-year basis from the tax code. So this is just a box you check. It's a line you fill out when you ask for your occupation, real estate professional. Once you do that, you now have this special golden ticket, this special power that I'm going to talk about in a second here. But what are these material participation things that you can do? Either you're developing, redeveloping, constructing, reconstructing, acquiring, converting, renting, leasing, operating, managing, or brokering property. So this is something I always say to real estate brokers. If you are a broker, you already are automatically a real estate professional. You are going to want to also invest or own rental properties so that you can get the benefits of depreciation. And what are those benefits? And now that we've defined what a real estate professional is, someone that works full-time in real estate, and they're doing any of these things, either they or their spouse, only one person needs that. Once you have this, you get this golden ticket status. What is this status? Essentially, and there's one exception over here. Okay, so I'll get to that in a second. Essentially, what it means is that rental income, okay, any income that you're getting from any of your real estate is considered passive income. Depreciation, all that we're talking about tonight, cost segregation, depreciation, that's considered a passive deduction. Those passive deductions can be used to offset your passive income, but that's it. It cannot flow over. So answering Janelle's question earlier, can you benefit if you're not a real estate professional? The answer is yes, but it's going to be limited. Meaning if you own real estate or you invest in real estate and you're getting income from those real estate investment properties, then the cost segregation can be used, those deductions, to offset the income from those properties. So you can make sure that you're not paying any income tax on whatever income you're getting from your investments or from your rental properties. However, you cannot use any of those extra deductions to overflow into your W-2 or to your active income. This is something also I think a lot of syndicators out there maybe misrepresenting, saying that yes, everyone gets the tax benefits and it's all hunky-dory, everyone's equal. It's not true. There is a big distinction between real estate professionals and non-real estate professionals when it comes to this. So let's just give an example. Let's say you made $50,000 from your rental properties. Okay, that's a lot. You invested a lot, whatever, and you make $50,000. But your spouse's W-2 makes, $300,000. So your adjusted gross income, let's say, is going to be $350,000. You do a cost segregation and get $200,000 of deductions. Well, $50,000 is going to wipe out your rental income. Okay, and you have this extra $150,000 from your depreciation. Now that's considered a passive loss, meaning if you're not a real estate professional, you cannot use that. You're still going to be taxed on the $300,000 from your W-2. Okay. However, if you're a real estate professional, those extra losses can then be applied to your $300,000 income, reduce that, cut it in half. And again, this is just an illustration, an example, but you get the point that you can, if you are a real estate professional, use those extra losses to offset your W-2 or your spouse's W-2 income. But if you're not a real estate professional, it's going to be limited to your rental or Schedule E, right, passive income. There's one exception to this, which is if you make less than $100,000 of adjusted gross income a year, then you can use up $25,000 of those passive losses also to offset your active income. Again, this is one exception. There's also a second exception, which we're not going to get into too much tonight unless someone has some Airbnb properties or short-term rentals, but there's another loophole called the short-term rental loophole that's going out there around a lot of content around that, at least in the past couple of years, specifically regarding short-term rentals or Airbnbs. If you have that, reach out to me. We can definitely discuss that because there's a way that you can actually use those deductions to offset your active income as well if you own an Airbnb property. So I hope that answered your question. Now, there is more to it, and we will get to later on how that will benefit a passive investor, because again, it's going to be a passive loss. You can't use it this year, but it will carry forward, and meaning you can use it next year or the year after, or until you sell the property. If you still have those losses, it will be released and you can use those losses to offset the gain, right, from the sale of the property. So there is still benefit there, just not in the current year as a real estate professional will have that benefit. Okay, now we're going to get to the Tax Cuts and Jobs Act. This was a big thing that happened with what's called bonus depreciation. So we talked about cost segregation, how you're going to get these bigger deductions in the earlier years, 5-year property, 15-year property. What happened with bonus depreciation in the tax reform a few years ago was that it introduced this law that says anything that depreciates less than 20 years, so all the things that we're going to identify with cost segregation, you can now take as a tax 100% of that in the first year. It used to be 50%, and that was specifically just for new construction properties. But now this is for anything that is even an acquisition, you're buying an older property. Remember what I said at the beginning, when you buy a property, your depreciation begins, that 27.5 years or that 39 years begins when you buy the property, even though the property was built in 1952. Doesn't matter. Your depreciation as a new owner starts this year. So this is really important. This is the last year it's going to be in effect as the 100%. Next year, 2023, it's going to start phasing out, going down to 80%, meaning you can still take the bonus depreciation, but only 80% of those accelerated deductions you can take in the first year, and then the remaining 20% can still be accelerated to 5 and 15-year property. So this is also something really important. Tons of people, and Whether this is going to change, who knows? But this has benefited, tons and tons of people over the past few years since this was introduced. And the CARES Act, this was something that was really interesting. It's not really relevant now, but net operating losses you could carry back. So I mentioned before, you can carry them forward, right? Your losses, if you can't use them this year, you can carry them forward. The CARES Act, and again, this is no longer applicable. This was something for 2020 and 2021 partially, but you could actually carry back losses to previous years. No longer applicable today. But I thought I'd just share that because historically you used to be able to carry back losses, meaning if you paid taxes last year or 2 years ago and you got a cost segregation done this year, you could then take those losses and apply them to previous years as well by amending your tax return. You can no longer do that. So when is the best time to get a cost segregation study done? And this is really a question that doesn't have an answer. The best time, really the best answer is when it's going to benefit you the most. Okay, that's when is the best time to do it. Because like I mentioned earlier, this is a tax strategy and everyone's situation is going to be different. And therefore, whether or not it's going to benefit you is going to be dependent on your situation. Okay, but most people find out that the best time to get it done is immediately after the first year because they want to set up the property's tax depreciation correct, right? The first year, the right way. And they want to make sure to get those losses and they will just carry those losses forward. So most people do get it done right away after the acquisition. However, a lot of people, what they do is reach out to a company like ours to get a analysis, a free estimate before you even close on a property. So I know a lot of people, especially syndications, hey, we're under contract, Yonah, can you run the numbers for me? Give me an estimate, show me what the potential tax benefits are going to be. And we do that all day, every day. So you can know immediately and you can show your investors what the potential tax savings would be, et cetera. So after the acquisition, after a renovation or addition, and this is something really important, when you buy a property, I mentioned your tax basis is going to be based on your purchase price. The only time that's going to change is not if you do a refinance or if it gets appraised higher. That will not change the tax basis. That will not change the amount of depreciation you can take. The only time that will change is if there's more money being added into the property via capital expenditures, renovations, rehab, and addition, et cetera. Any more money spent can and should be depreciated. And then that amount spent, you can break up into those different components through a cost segregation study and get extra tax deductions that way as well. Newly constructed property, again, you can do this on a new construction. And something a lot of people don't realize that you can do this on a property you've owned for a number of years. This we call look back study or retroactive study. If you own a property and you never did cost segregation, you've owned it for 2, 3, 5, 10 years, you can actually go back without amending your tax returns and catch up whatever depreciation you missed that you could have taken. And this year, take a big lump sum of that accelerated depreciation. So this is something also really, really important. A lot of people aren't really aware of. You can do this look back study. So any questions thus far? I see someone had a question here. Study your savings in new construction. Okay, Isabel, what is the savings in new construction? Simply put, right, what we're doing with the cost segregation is breaking down the components into their different depreciation categories. Okay, so when you build a new property, let's say you spend $1 million on building the property, some things are going to the windows, the doors, the frame, the foundation. Those are all going to be structural components are going to depreciate on a 27.5-year schedule. But components that are non-structural are going to be depreciated on those faster schedules. So what we're going to do is do a cost segregation study and break down all those components and show where each component should be depreciated and how you can actually take those tax deductions going forward once it's a new construction, if it's being held as a rental. So if it's a new construction that is going to be sold off, you can't do a cost segregation there because, again, it's not a rental property. So this the only time this is going to apply is when it's going to be a rental property. So I hope that answered your question. If it didn't, please put something back in the chat and we can go into that a little bit later. A multifamily, okay, case study here, guys. Who wants to hear a case study? Case study is this person bought a 32-unit property, really beautiful looking property here for $1.75 million. This was a few years ago, as you can imagine, because try finding a 32 unit that looked so nice for for 1.75 million in today's market. I doubt you can find it, but this person was able to, and it was his first multifamily purchase after many single family rentals. This is going to be an important point as I will share this story in a minute. Without cost segregation, depreciation would have been approximately $54,000. Again, we're taking the 1.75 million, subtracting a certain amount for land, dividing that by 27.5 equal straight line depreciation, 54,000. Now, the net operating income on this property was over $100,000, but I think about $120,000. That meant that the normal depreciation deduction would have still meant that they had a tax liability of about $70,000. Okay. Now, tax liability $70,000, depending on your tax rate, how much actually tax are you going to pay? $25,000, $30,000, something in that range, probably if you have a high tax rate. That means net savings for him would have been, around $70,000, $30,000. However, in this case, and the reason why I mentioned that it was the first multifamily after many single families, what this gentleman tried to do was a 1031 exchange. Okay, he had a lot of single family properties, wanted to sell them all off and take those proceeds, roll them in through a 1031 exchange, which is a tax process that allows you to defer the capital gains tax on the sale of a property and allows you to put that and basically exchange one property for another. We're not going to talk too much about 1031 exchanges today, but the concept is that's what this person wanted to do. There's certain timelines that you have to keep to, and he wasn't able to keep to it for whatever reason. It fell through, and he was going to end up paying approximately $300,000 in capital gains tax. Okay, that was a tax bill after selling these properties. And as you can imagine, it's pretty upsetting, right? Paying $300,000. Obviously, like many people might say, and I've heard this, tell me in the chat if you've heard this before, that if an accountant says, well, if you're paying high taxes, it means that you're making a lot of money and you should be grateful for that, right? And yeah, anyone heard that before? Well, that may be true, but if there's a way to get around that and there are strategies to minimize your tax burden, then that's even better. So that's what this person did. They did a cost segregation study, and you can see the purchase price allocated 15% for land, and the remaining amount we were allocating into three different categories. One is the structural components, 27.5 year. That's again 72% was what we found total. 122,000 was the 15-year property. That's again land improvements, landscaping, pavement, concrete, etc. And then the 5-year property, which is the majority, was 298,000. So altogether, the amount of depreciation that you could take in the first year with bonus depreciation was over $420,000. Not only did that wipe out their $120,000 income from the property, which they paid zero taxes on that, but also had an extra $300,000 of deductions to wipe out the capital gain tax. So literally paid zero income tax and zero capital gain tax just by doing a cost segregation study. So yeah, that is really, that's the story of the multifamily. You can see this was an incredible opportunity. Now, the question may be asked, and I don't know if anyone's asking this, but if you aren't, I'll ask it for you. Well, what happens in the next year, right? If you take all these deductions up front, do you have any deductions left the next year? And the simple answer is yes, absolutely. Because again, what we're doing is accelerating the 5 and 15-year property about 28%. You still have this remaining 27.5-year property, 72%, that we're still going to be deducting over the those faster depreciation, those right straight line depreciation schedule. So of the 54,000, right, you still have about 72% of that you're taking each year, which turns out to be about $45,000 a year. So you're not losing too much in terms of yearly deduction. What you are gaining is that huge amount of tax benefit in the first year. And if you, the next year, continue to invest or continue to buy properties year after year, you'll continue to use this strategy to pay little to no income tax. And as Christine mentioned, her own personal story was, going from paying 6 figures to paying zero income tax and getting actually a refund. Because if you pay prepaid income tax, which a lot of people do for your W-2, right, prepaying, you can actually get a refund if you have more deductions at the end of the year. So that's the case study over here. What else do we got have in the slides? This is what's called the principal elements of a quality cost segregation study. This is taken directly from the Cost Segregation Audit Techniques Guide. So if you want to know if a cost segregation study is going to hold weight, you want to make sure that the company is following all the principles of this study, because this, again, All the rules for this were created by and are governed by the IRS. So you can go to their website and check out the Cost Segregation Audit Techniques Guide. And you can see here, there's a whole numbering system, there's a whole nomenclature, there's documentation needs to go on. Or we're producing an 80, 90, 100-page report with this cost segregation study that has all, the identification listing of the tax code, right? The whole thing. So definitely not something that can be done on the back of a napkin, and not something that can be done by just throwing a dart at the wall and figuring, okay, Yonah said 28%, we can take 28% of our property and just do that. Now you actually need to back up your work. Obviously, in case of an audit, you want to make sure you have the work to do that. So any other, let's see what we have here. That's just our company, no much there. Questions, kind of move through that, but definitely open for questions. And as Christine and Margaret mentioned, you can definitely contact me on LinkedIn or any other place, or yonahweiss.com. And that's what I have for you. But again, happy to answer any questions that you may have.
That was amazing, Yonah. Thank you so much. I think I had a question, but I think you answered it, which is, so in that instance where you had, let's say, $400,000 worth of expenses, which wipes out the capital gains, anything extra, you cannot roll it over into the next year anymore. Is that correct?
If there is any extra losses will always be carried forward to the next year. So yes, you can carry those extra losses forward.
Oh, okay. For some reason, I thought you were saying something with a look back that you can't do it. So I was getting confused with that part.
No, you can. There was something what was called the passive loss activities, which you can no longer carry back the losses, meaning you can no longer apply those losses to previous tax years by amending your returns. So let's say you got $400,000 in depreciation this year, and last year you paid taxes. Can I go apply that to last year and get a refund? That's something you can no longer do.
Okay, got it. That is super helpful. So, okay. So if there's anybody else who has any other questions, please put them in the chat. It's a complicated subject, but actually I think, Yonah, you made it actually pretty easy. Okay. Can the cost seg apply into a portfolio of single family homes?
That's an excellent question. It certainly can. However, usually with a cost segregation, we're going to need to look at every single property individually. And so this is why, people will ask, and I didn't really bring it up today, but most people ask when I do these presentations, what type of property is like the minimum that's worth getting this done, right? And usually my rule of thumb is like anything over $500,000 or even $300,000 purchase price is going to be extremely beneficial. However, if a portfolio of single families, unless they were bought as a portfolio or are like in a similar development, all, literally right next to each other and similar build, et cetera, unless they're like that, we're going to need to do a cost seg on each and every individual house, which again is going to be costly and may not be beneficial. However, if they were bought as a portfolio, we could actually do it as like one lump sum. So like, for example, there's people doing these build to rent scenarios now where you're building a whole community, and they're all same developer, right? Similar floor plans, et cetera, same build. And it's just being like a horizontal multifamily property, as I like to call it, right? That you could just do one big cost segregation on the whole thing, because even though they're individual houses, we can lump it all together into one study.
I am also going to share my screen while we're waiting for the additional questions, so that if anybody has additional information for Yonah, there's our contact info, there's Yonah's contact info. And, as we're discussing this, we're sort of almost, I just want to make sure that everybody knows this is definitely appropriate for passive investors. You don't have to be that active landlord. You don't have to be that active operator. In fact, this is one of the benefits you get when you do invest passively in multifamily or any other asset. So definitely, if you're interested in this type of, especially if you're a real estate professional, because I know we have some realtors on here, definitely you'll want to book a call with Christine or myself. That way you'll get access to some of these deals. And I also know that we've got a lot of active real estate investors on there, and you're going to want to book a call with Yonah to figure out how you can do your cost segregation. So that's really, really important. We kind of have something for everyone, whichever boat you fall into. So Christine, do we have any other questions? I can't see now since I'm sharing my screen.
Nope, I don't see any more questions.
Okay, awesome. I think everyone is so stunned with the wisdom that you have put forth here today.
Yes,
But
it's amazing.
yeah, we'll wait a few more minutes and we'll chat for a bit. But again, it's a lot to wrap your head around, and I just want to emphasize this is why you want to have a Yonah on your side to help you go through this, because even so many people, Yonah, I think they think, of course, about depreciating the building, but they don't think about the fixtures or the improvements to the land, or there's so many things that you can actually use to deduct that I suspect a lot of people are missing quite a bit. You're muted, actually.
Yeah, no, just absolutely. People don't think about it, and unfortunately, even accountants may not know about this, or or talk about this to their clients. So it's unfortunate.
Yeah. The other thing I thought it was interesting that you said is that we're not making up these deductions. We're not coming up with these things out of thin air. These are things, legitimate, physical, tangible assets that can be depreciated that just probably weren't being considered in the past.
100%.
So
I do have a question. What does the process of doing a cost segregation on a property look like?
Pretty straightforward, pretty simple. Like I said, we always like to do a free estimate beforehand so you can know ahead of time. So that's always the first stage we like to do. And then in terms of the process, it's like a threefold process. So number one, first thing is we always schedule a site visit for our engineers to go to the property. Now, we won't always send our engineers physically there. A lot of times we're going to do what we call a virtual walkthrough. So just to keep it safe. And also, it's just time-wise, it makes it more efficient for most types of properties. We can have one of our engineers have a video call with the property manager or someone, just have a video walkthrough of the property that way. Then we'll take some information like closing statements, appraisal, things like that, gather documents, and our team will work about 6 to 8 weeks on actually compiling this study, and then turn around, again, that study, which will produce a new depreciation schedule. So it's a pretty simple, unintrusive process. Like I said, usually takes about 6 to 8 weeks, but will be, it's just a huge, huge game changer.
Awesome.
And to piggyback on that question, so then do you have CPAs that you work with? Because it sounds like you provide this segregation study, and then what do people do with that? Like, do they take it to their CPA? What's the next step?
Yeah, so we have a whole team of CPAs on staff. We're not an accounting firm, so we don't do any tax filing or tax planning or anything like that. But our CPAs that work on staff are, solely just focusing on making sure every study is compliant, and also as a liaison to other people's accountants to make sure that they understand it and can apply it. It is pretty straightforward, but for CPAs, right, that have never seen something like this before, they just may not get it. And so it's really literally a daily task for us to just show you, like, this is your depreciation. You just take it and you plug it in your Schedule E. It's very, very simple.
Got it. So I've got a question for any house hacker out there. I myself am a house hacker. Does a cost segregation exercise apply to those who are house hackers? Because it's kind of like half investment property and half primary residence.
Yeah, that's an excellent question as well. It can apply. Again, depreciation is only going to be for rental properties. But if you're renting out a room in your house, or renting out, right, a unit in your house, that prorated area or amount of the house is considered rental property, and you can claim depreciation on that amount. So not the full amount. So just to keep it simple, let's say your house hacked a duplex and you were living one unit, the other unit renting out, and you bought it for $1 million. You'd only be able to take 500,000, right? Half of that as your depreciation basis. But you could do it on that amount.
Got it. Very cool.
All right, so if there's no other questions, that I think we can go ahead and wrap up. But again, make sure to reach out to Christine and I if you're interested in any of these type of passive opportunities. We didn't really talk about the benefits of passive income, but obviously, it's something that can eventually help you replace your W-2 income. And guess what? Then you're a real estate professional. And then you can go to Yonah and use all these cost segregation studies and really, really do well. And obviously there's Yonah's information as well. You know, I
Yep.
also encourage you to, I'm sorry, was there one more?
Oh, we have one more question that just came in.
Oh, sure.
Yeah, so how's the pricing of a cost segregation structured?
Yeah, excellent question as well. It's not contingent on tax savings. So we have a basically sliding scale based on the size and type of property. Again, it has nothing to do with how much the tax savings are or anything, a percentage of that, anything like that. So typically our fees are anywhere from like the smallest type of property, like single family, something around $3,000, and then up to like, multifamily commercial properties can get up to around like 6,000, 7,000. If it's larger commercial properties, maybe a little bit more, but again, totally based on the size and the scope of work of the property. But definitely not like it says, like you'll find on some online forums or online articles that it's like $20,000, $30,000, $40,000, and therefore it's only worthwhile for huge properties. That's simply not true.
Got it. Thank you for that.
All right. So all I was going to say is to make sure to connect with Yonah on LinkedIn. He puts a lot of amazing content out there, and you will also get access to his podcast as well. So Yonah, we want to thank you so much for joining us. I know I've learned some new things, and we really very much appreciate your time tonight.
My pleasure. Thank you guys for having me, and I hope everyone learned something new.
Sounds good, everyone. Thanks so much. Have a great night.
Thank you.